Imagine reaching a specific financial threshold where the stress of paying bills, the anxiety of unexpected expenses, and the fear of the future simply melt away. In the world of personal finance, this number is known as your financial independence number, and achieving it is much more attainable than you might think. By understanding the mathematics of wealth accumulation, the power of compound interest, and how to align your savings rate with your annual expenses, you can create a personalized financial blueprint that transitions you from living paycheck to absolute financial peace of mind. Today, we are going to dive deep into exactly how to calculate this magic number, the psychological and practical steps required to hit it, and how you can start implementing a bulletproof strategy to secure your financial future once and for all. Part 1. Understanding the financial independence number. The financial independence number is the specific amount of capital you need to accumulate so that the passive income generated by your investments covers your annual living expenses indefinitely. At its core, this concept relies on the 4% rule, a widely accepted financial principle suggesting that you can safely withdraw about 4% of your total investment portfolio during the first year of retirement, adjusting for inflation in the subsequent years. To apply this rule, you multiply your total annual expenses by 25 to determine your target number. For instance, if your household spends about $60,000 annually, you would need a portfolio of $1.5 million to achieve financial independence. Understanding this math transforms wealth from an abstract, unreachable dream into a concrete, measurable target that you can track with precision over time. To accurately determine this number, you must look closely at your actual living expenses rather than your current income, which is a common trap for many people who try to base their financial goals on salary rather than consumption. You need to separate your needs from your wants, identifying exactly what it costs to maintain your lifestyle without relying on a traditional paycheck. This means analyzing your housing, food, transportation, healthcare, and insurance costs, while also considering potential future changes, such as paying off a mortgage or dealing with inflation over a long time horizon. By categorizing and optimizing these expenses, you can lower the total amount of capital required, which significantly reduces the amount of time and effort needed to reach your financial independence goal. Grasping the mechanism of this milestone shifts your entire psychological relationship with money. Instead of feeling trapped in a never-ending cycle of earning and spending to keep up with lifestyle inflation, you begin viewing every dollar saved as a tool that buys back your time and freedom. The target amount acts as a clear benchmark that guides your savings rate, investment choices, and career moves, allowing you to make strategic decisions that accelerate your path to early retirement or complete financial autonomy. This knowledge gives you the framework to take actionable steps right now, such as automating your investments, cutting unnecessary subscriptions, and focusing on long-term wealth accumulation rather than short-term gratification. Part 2. Calculating your target wealth goal. To accurately calculate your target wealth goal, you must start by projecting your future annual expenses and multiplying them by 25. This formula is derived from the widely accepted 4% rule, which assumes that a diversified investment portfolio can generate enough returns to cover your living expenses and protect against inflation without depleting your principal capital. For instance, if you estimate that you will need $80,000 annually to maintain your lifestyle, your wealth target should reach $2 million. This mathematical approach removes the guesswork from your financial planning and gives you an exact, measurable figure to use as a compass for all your saving and investing decisions. Once you know this overarching number, the next step is to break down your long-term goal into actionable, short, and medium-term milestones, so the total amount does not feel overwhelming. It is critical to track your current net worth, which encompasses the total value of your investments, savings accounts, and physical assets, while subtracting any liabilities like consumer debt or mortgage balances. By monitoring how your net worth grows quarter by quarter, you can adjust your contribution strategies, optimize your asset allocation, and evaluate whether you are on the right track to hit your target number. This incremental progress mindset keeps you motivated and allows you to make strategic corrections well before any major deviations occur in your long-term financial plan. Furthermore, you must account for the impact of inflation and taxes when defining your wealth target to ensure you do not fall short decades down the road. The cost of living rises over time, meaning the purchasing power of your money today will be significantly lower in 20 or 30 years, requiring you to factor a conservative inflation rate into your calculations. Additionally, consider the tax implications of your investment accounts, as withdrawals from traditional vehicles, such as retirement or standard investment accounts, will be subject to income tax. By incorporating these variables into your math, you build a realistic and robust target that will genuinely protect you against economic fluctuations and ensure lasting financial stability. Part 3. Leveraging compound interest and investment vehicles. Compound interest is the most powerful mechanism for building wealth and accelerating your journey toward financial independence. When you invest your money, the earnings generated begin to generate their own earnings, creating an exponential growth curve over time. This effect becomes significantly pronounced when you reinvest dividends and capital gains, allowing your portfolio to grow much faster than if you only rely on the initial principal. The earlier you begin, the more time this exponential growth has to work in your favor, turning modest monthly contributions into massive sums over a period of decades. Understanding this mathematical reality means you stop viewing investments as a quick trading game and start treating them as a patient, long-term wealth engine that works around the clock. To effectively capture this growth, you must allocate your capital into the right investment vehicles that offer broad market exposure and low fees. Exchange-traded funds and index funds are excellent foundational tools for both beginners and intermediate investors, as they allow you to own a diversified slice of the entire economy, such as the 500 largest publicly traded companies in the United States. By avoiding individual stock picking and focusing on low-cost broad market funds, you minimize the risk of severe losses while ensuring your money participates in the long-term upward trajectory of the market. The key here is absolute consistency, meaning you should continuously invest a fixed percentage of your income, regardless of whether the market is up or down. For those looking to optimize their wealth accumulation at an intermediate or advanced level, utilizing tax-advantaged accounts is a vital strategy to maximize returns. Accounts like a 401k, a Roth IRA, or a traditional IRA shield your investments from the full brunt of taxes, allowing your compound interest to work on a larger pool of money. Furthermore, advanced investors can diversify by exploring a mix of growth-oriented assets, dividend-paying stocks, and real estate or fixed-income securities to balance risk and reward. This layered approach ensures that as your net worth grows, your tax burden is minimized and your portfolio remains resilient against various economic conditions, keeping you firmly on track to hit your target wealth goal. Part 4. Streamlining your savings rate and living expenses. The speed at which you reach your financial independence number is primarily determined by your savings rate, which is the percentage of your income that you save and invest rather than consume. If you save 10% of your income, it can take several decades to build enough wealth to retire, whereas increasing your savings rate to 50% or more dramatically reduces the timeline to less than 2 decades. This relationship exists because not only are you investing more capital, but your living expenses are also significantly lower, meaning the absolute amount of capital required to cover your lifestyle is reduced. By intentionally increasing the gap between what you earn and what you spend, you create a powerful compounding effect that accelerates your progress toward complete financial autonomy. Optimizing your living expenses requires a disciplined approach to eliminating unnecessary spending without sacrificing your overall quality of life. This process involves a thorough audit of your monthly outflows, from housing and transportation down to recurring subscriptions and discretionary spending. You can take immediate action by negotiating bills for services like internet and insurance, consolidating subscriptions you no longer use, and planning your meals or groceries to minimize food waste. The goal is not to live in deprivation, but rather to direct your financial resources toward activities and assets that truly bring you value and help build your wealth, while stripping away the financial leaks that drain your monthly surplus. Maintaining these streamlined expenses over the long term requires building sustainable habits and utilizing tools that automate your financial life. You can set up automatic transfers that send your target savings amount to your investment accounts the moment you receive your paycheck, ensuring you pay yourself first before any spending temptations arise. Furthermore, regularly tracking your net income and expenses using simple spreadsheets or dedicated applications allows you to identify trends in your consumption and make adjustments as your income or circumstances evolve. By institutionalizing these habits, you make financial discipline a natural part of your routine rather than a daily struggle, keeping you firmly on the path to financial freedom. Part 5: Protecting your assets and planning for long-term sustainability. Reaching your financial independence number is a massive achievement, but the work does not stop there. Protecting your accumulated wealth is crucial to ensure it lasts for the rest of your life. You must implement robust risk management strategies, which include having adequate insurance policies, such as health, liability, and property insurance, to shield your portfolio from unexpected catastrophic events. Additionally, maintaining a liquid emergency fund covering at least 1 year of living expenses ensures that you do not have to sell off your investments during a market downturn to cover unexpected emergencies. By establishing these safety nets, you create a fortress around your wealth that allows your investments to remain invested and continue growing without disruption. Once your portfolio reaches your target wealth goal, planning for long-term sustainability requires a careful and strategic withdrawal rate that adapts to market fluctuations. Instead of selling assets blindly, intermediate and advanced investors utilize a dynamic withdrawal strategy, meaning you might reduce your spending slightly during severe bear markets and increase it during market booms. This flexibility protects your capital from being depleted too early, especially during prolonged economic downturns when the sequence of returns risk can severely impact a portfolio. Furthermore, diversifying your assets across different classes, such as index funds, bonds, and real estate, acts as a buffer that stabilizes your income and preserves your principal over the decades. Finally, ensuring the long-term sustainability of your wealth involves formalizing your estate plan and keeping your tax strategies aligned with your current income and asset levels. Drafting a will, establishing a trust, and naming beneficiaries for your accounts prevents your wealth from being tied up in lengthy and expensive probate processes, protecting the legacy you intend to leave behind. This level of advanced planning gives you absolute peace of mind, knowing that your hard work is not only securing your own future, but also protecting the financial well-being of your loved ones. By taking these final steps, you guarantee that hitting your financial number truly means you will never have to worry about money again. Reaching your financial independence number is not just about the money. It is about buying back your time, achieving true peace of mind, and taking control of your destiny. As you apply the steps we discussed today, calculating your goal, harnessing compound interest, and streamlining your expenses, you are building a future where money is no longer a source of stress, but a tool for living life on your own terms. If you found this information valuable and want to continue building your wealth, Please hit the subscribe button and turn on notifications so you never miss an update from Sam Invests. Also, leave a comment below with the phrase, "I am building my financial freedom" today to let us know you are committed to reaching your target number.